In a market that feels like it only moves in one direction. What if I told you there's an incredibly powerful strategy that does the complete opposite? Today, we're going to dig into a method for finding hidden gems in the most overlooked corners of the market. And honestly, it's a strategy that might be more critical for your portfolio right now than it has been in decades.
I love this quote, because you've probably felt this, right? The entire market seems to hang on whatever a few giant companies do each day. After that massive AI-fueled rally we saw in 2025, this isn't just some clever joke anymore. It is a stone-cold reality check for anyone invested in a simple index fund.
And here is the number that should really make you sit up and pay attention. The top 10 companies, just 10 of them, now make up a staggering 32% of the S&P 500's total value. We haven't seen anything close to this level of concentration since the 1970s. Just think about that for a second. 2% of the companies are dictating the performance for nearly a third of the entire index.
Now, this isn't just some fun fact to throw around. It's a huge hidden risk that's embedded in millions of portfolios. If you're passively invested in the S&P 500, you are making a massive, concentrated bet on just a handful of companies, whether you realize it or not. So, in this explainer, we're going to go on a treasure hunt. We're going to find the other 495.
Okay, so first things first, let's really break down exactly why this concentration is such a big deal, because understanding the risk is always the first step toward actually managing it.
Yeah, think of these high-flying stocks as being priced for perfection. It means investors are paying a huge premium because they're assuming everything will go right. Flawless earnings reports, perfect product launches, you name it. But perfection is a pretty fragile thing. The second one of these giants has even a tiny stumble, it doesn't just hurt that one stock, it can literally pull the entire market down with it.
And if you need more convincing, history gives us a pretty stark warning here. The last time the market was this top-heavy was way back in the 1960s. And you know what happened next? A long, painful, sluggish period where the index returned a measly 6.2% a year for over 15 years. Now, history doesn't repeat itself perfectly, but it sure does rhyme. And this pattern, well, it suggests periods of extreme concentration often lead to years of really disappointing returns.
So, if chasing momentum, chasing what's already hot, has led us into this massive concentration risk, what's the logical counterattack? Well, it's a strategy built on the complete opposite principle, mean reversion.
It's kind of like a stretched rubber band. You can only pull it so far in one direction before it's bound to snap back. Well, in finance, that force is called mean reversion. The idea is that what goes way, way up eventually tends to come back down to its average, and what's been beaten down often finds a way to recover. These extreme moves, they're rarely permanent.
So what you're seeing here are really the two fundamental forces that are always battling it out in the market. Momentum investing is all about physics. An object in motion stays in motion. You let your winners run. But mean reversion, that's like gravity. What goes up must eventually come down. Neither one is wrong. They're just opposing forces. The real secret to smart investing is figuring out which one is in control at any given time.
And listen, this isn't some fringe idea from the dark corners of finance. We're talking about legendary value investors. Even hyper-successful super-secretive quant funds like the Medallion Fund have used this as a core principle for decades. They build these incredibly complex models just to bet that prices that have gone too far from their historical norm will eventually snap back.
Okay, that's the theory, but how do we actually do this? How do we translate this powerful idea into a practical strategy? Because it's definitely not about just blindly buying stocks that are down. It's about a disciplined, top-down framework for finding real opportunities.
The process is kind of like using one of those Russian nesting dolls. You start with the biggest doll, the 30,000-foot view of the overall market, just to get your bearings. Then you open it up and zoom into specific sectors to see where money is flowing in and, just as importantly, where it's flowing out. And only then, at the very end, do you get to the smallest doll and start looking at individual companies.
Right, so think of the market as a big city with different neighborhoods. For the last couple of years, all the hype, all the capital has flooded into one trendy district, tech or XLK. But our strategy is to go explore the forgotten neighborhoods, the ones that have been sold off or totally ignored. This is where we start our hunt for real value.
All right, now we're getting to the crucial step. This is the secret sauce. Finding a beaten-down stock, that's easy. But finding one that the smart money, the big institutions, are quietly buying up, that's where you find your alpha, your real investing edge.
So you've done the work, you've found a cheap-looking stock in an unloved sector. Now comes the million-dollar question. Is this thing a genuine bargain? Or is it cheap for a very, very good and potentially very painful reason? The answer really lies in following the smart money. See, the single biggest driver of a stock's price is demand from large institutions, pension funds, mutual funds, that sort of thing. When they decide to start buying, they don't just nibble, they buy millions and millions of shares, and that creates a powerful tailwind. Our goal is to spot their footprints in the sand before the rest of the market does.
So, how do we spot those footprints?
Well, one of the most powerful tools for the job is a technical indicator called the Relative Strength Index, or RSI, specifically on a weekly chart. When you see that weekly RSI start to climb out of oversold territory, that's a reading below 30, it can be a massive clue. It often signals that the wave of panicked retail selling is finally running out of steam, and the slow, steady buying from the big institutions is just beginning.
But wait, before you run off and start buying every stock with a low price-to-earnings ratio, you absolutely must learn to avoid the #1 risk of this entire strategy, and that is the dreaded value trap.
You know, the legendary Charlie Munger had this incredible line that reminds us to be deeply skeptical. Some companies, just like some minds, they look so promising on the surface, but underneath, they're fundamentally broken. And our job is to tell the difference.
And this right here is the official definition of a value trap. It is the siren song for bargain hunters. The stock looks cheap, the PE ratio is low, but it's all a trap. The price just keeps getting cheaper and cheaper and cheaper because the underlying business is in a permanent state of decline.
You need to burn this slide into your brain. Seriously, a low PE ratio is a starting point for your research. It is not the conclusion. You have to ask yourself, is this business like a melting ice cube with earnings that are just slowly disappearing? Because that's a value trap. Or is it a coiled spring with a real, clear path to growing its earnings again in the future? That's a potential opportunity.
Okay, we have covered a ton of ground here. We've talked about the why, the how, and the what to avoid. So now, let's put everything together into a simple, step-by-step playbook that you can actually use.
Here it is. This is your strategic roadmap. First, just acknowledge the concentration risk in your own portfolio. Second, you've got to shift your mindset from chasing hype to hunting for value. Third, follow that top-down process. Market, then sector, then stock. Go look for those technical footprints of institutional buying. And finally, always ask that critical question. Is this a bargain or is it a bust?
And this is really the final thought I want to leave you with. In a market that is obsessed with just a handful of superstars, there is a whole world of opportunity that might just be hiding in plain sight. It's a challenge, for sure, that shifts your focus from chasing the popular kids to uncovering the hidden gems. The real question is, are you willing to look where nobody else is?